Welcome, everyone, to a very focused exploration today, really crafted specifically with you in mind. Today, we're embarking on a deep dive into what many discerning market participants see as a truly foundational stage. Foundational, yet, often overlooked in the stock market's life cycle. We get that you want to gain knowledge efficiently, but also thoroughly. So we are really setting our sights on the world of stock market accumulation.
Exactly. And this isn't about chasing those, quick gains or reacting to every single headline that pops up.
No, definitely not.
Instead, we're focusing on that key period after a price decline, a time when something pretty significant starts to stir, sort of beneath the surface.
Consider this your personal key, maybe, to unlocking how that groundwork for future growth is quietly laid.
That's a great way to put it. We're going to delve right into the nuances of this accumulation phase. It's a period that really rewards patience. It demands a keen eye. Think of it like a season where the seeds for the next big upward move are being sown, often completely unnoticed by most people out there.
So our main goal today is to really illuminate what defines this phase, explore the psychology behind it.
Precisely. And articulate why getting a more informed, maybe more sophisticated perspective on accumulation can give you a real advantage. A considerable one, potentially.
Okay, let's start to unpack this. Maybe first we should place the accumulation phase within the bigger picture, the market cycles.
Good idea. A really respected framework for this comes from Dow Theory. It basically describes the market moving in these discernible cycles.
Right, and that theory outlines 4 distinct phases, doesn't it?
It does, 4 interconnected phases. The very first one is accumulation. That's our focus today.
Okay, phase 1. Accumulation.
Then after that, you get the public participation phase. This is where, the broader market starts catching on. Activity picks up, enthusiasm grows.
So more people jumping in.
Yeah. And that's followed by the distribution phase. This is where those investors who got in early during accumulation might start selling, cashing in as enthusiasm peaks.
Selling into strength, essentially.
Exactly. And finally, the cycle wraps up with a decline phase. Prices fall, sentiment shifts from optimistic back towards caution, or even pessimism.
Understanding those phases, as you said, it sounds absolutely crucial.
It really is. It gives you a kind of roadmap, helps you align your strategy with what the market's actually doing.
Yeah.
Each phase has its own unique feel, its own patterns. Recognizing which phase you're in, that can significantly boost your understanding.
All right, so let's really dive deep now into that first stage, accumulation. You said it emerges after a sustained price decline.
Generally, yes. The market's gone through a correction, maybe even a bigger downturn. And this phase, importantly, it signals the potential start of a new uptrend.
Okay, and you mentioned smart money playing a key role here.
Yeah.
Who exactly falls into that category?
Yeah, smart money, it typically refers to professional investors, large institutions, think hedge funds, pension funds, those kinds of players.
Yeah.
They have significant capital, sophisticated analysis tools, and crucially, a long-term perspective. They can look beyond the day-to-day noise.
So while the average person might still be feeling negative or just uncertain after the drop.
Exactly. While the public is bearish or hesitant, these informed players start buying, selectively, deliberately buying shares.
And they do it discreetly, you said.
Very discreetly, often, in a measured way. They're not trying to cause big price spikes immediately. The goal is to build their positions steadily over time without drawing too much attention.
Makes sense. They want to get in while prices are relatively low before everyone else piles in. So what does this quiet buying actually look like on a chart? What's the typical price movement during accumulation?
Well, the defining characteristic is often sideways movement. You'll typically see prices trading within a pretty well-defined range. There's a support level below, where buying seems to hold it up.
Like a floor?
Right, a floor. And there's a resistance level above, a ceiling, where selling pressure stops it from going much higher for a while.
So consolidation. It probably feels quite uneventful compared to a big drop or a big rally.
It's exactly. Uneventful, maybe even boring for many traders. There aren't those dramatic swings. It's stabilization within that range.
That boredom factor is interesting. It deters people, but it's actually an opportunity for those who understand what might be happening.
Precisely. That apparent stillness often comes before a significant move. Patient accumulators know this.
And what's happening with trading volume during this sideways period? The amount of buying and selling.
Initially, volume is often pretty low. It reflects that lack of widespread interest we talked about. The public isn't really engaged.
Still licking their wounds, maybe, or waiting for clearer signals?
Could be. But as the accumulation phase progresses, and if that smart money keeps buying, you might start to see a gradual increase in volume. Particularly, you might notice it picking up a bit on days when the price moved towards the upper end of that trading range.
Okay. So slightly more activity when prices try to push higher within the range.
Yes, that subtle increase in volume on the up moves can be a quiet sign that underlying demand is starting to strengthen.
Interesting dynamic. Low volume overall, but maybe picking up on the rallies. Now, you sometimes hear about false breakouts or springs. What are those about?
Yes, springs are false breakdowns. They're fascinating, and they can definitely trip you up if you're not aware. What happens is, during accumulation, the price might briefly dip below that established support level, that floor we mentioned.
Okay, so it looks like it's breaking down further.
Exactly. And that move can be designed to trigger stop-loss orders. Orders traders place to automatically sell if the price drops to limit losses.
So it shakes out the less committed traders.
That's the idea. By pushing the price down briefly, the accumulators might be able to grab more shares at slightly lower prices from those forced sellers. Then, after that quick dip, the price typically snaps back, rebounds relatively quickly back above the support level.
Like a spring coiling and uncoiling?
Precisely. It's like the market shaking out the weak hands before the real upward move begins.
So understanding that isn't just about avoiding getting stopped out, it could actually be a signal itself.
It could be. It might suggest the accumulation phase is getting mature, maybe nearing its end. The smart money might be testing if there are many sellers left before they really let it run.
Okay, so while this smart money is quietly buying, maybe orchestrating these springs, what's the mood like for most other traders? What are they feeling?
For most people, it could be a really frustrating time. After a drop, you hope for a quick recovery. Right?
Yeah, you want it to bounce back fast.
But instead, you get this sideways, seemingly directionless movement. That lack of progress leads to boredom, a feeling that nothing's happening.
Plus the memory of the recent losses.
Right, that lingers. So there's often still hopelessness or at least deep uncertainty about where prices are headed. Many individual investors just get discouraged and move on.
It really is a study in contrast, isn't it? Public frustration and boredom. While the smart money sees that same period as, well, an opportunity, why is that environment so appealing to them?
Because that very lack of interest and the negative sentiment are perfect cover. They can build their positions without attracting attention and, crucially, without pushing the price up too quickly against themselves.
So the negativity actually helps them accumulate at lower prices.
Exactly. Their approach is patient, disciplined. They have a long-term view. They understand that big moves often start in these quiet periods. They're willing to wait and build their stakes.
Okay, this leads to a really practical question then. How do you tell the difference between this accumulation phase we're discussing and the distribution phase? Because distribution can also involve sideways price action, right?
That's a critical distinction to make, absolutely. They can look similar on the surface, but the underlying dynamics are opposite. There are key differences to watch for.
What's the first big clue?
The preceding trend is usually the biggest giveaway. Accumulation, remember, typically follows a downtrend. Prices have been falling.
Right.
Distribution, on the other hand, happens after a significant uptrend. Prices have already run up a lot.
Okay, so context is key. What about the price behavior within the sideways range itself? Any subtle differences?
There can be. In accumulation, while it's sideways, you might see a subtle upward bias within the range. Maybe slightly higher lows, indicating buying pressure is slowly building.
Okay.
In distribution, you might see the opposite, a subtle downward drift within the range. Maybe slightly lower highs, suggesting selling pressure is gradually increasing as big players unload shares.
Got it. And volume patterns, how do they differ?
Volume is another big differentiator. In accumulation, we said volume tends to be low initially, then maybe picks up gradually, especially on rallies within the range. In distribution, volume is often high, particularly on days the price dips or sells off within the range. This suggests large holders are selling into buying interest, unloading their shares.
So high volume on down days during distribution, potentially rising volume on up days during accumulation. That's a key contrast.
It really is.
Yeah.
And then there's public emotion. Huge difference. During accumulation, the dominant feelings are often fear, boredom, maybe disbelief that prices could actually go up again.
Still recovering from the drop.
Yeah. But during distribution, it's often the opposite.
Yeah.
Euphoria, excitement, even greed as the public gets really optimistic after the long run-up. Everyone wants in.
Almost a mirror image of sentiment.
Pretty much. And the role of the institutions reflects this. In accumulation, it's quiet buying.
Right.
In distribution, it's strategic selling. They're taking profits, feeding shares into that enthusiastic public demand.
Okay. Any typical chart patterns associated with each?
Yes, patterns can offer hints too. Accumulation might show bottoming patterns, things like double bottoms or those springs we discussed. Signs the downward trend might be ending.
And distribution.
Distribution might show topping patterns like head and shoulders tops or double tops. Signs the uptrend might be running out of steam.
And finally, volatility. The size of the price swings.
Generally, accumulation tends to be relatively quiet, stable price action. Distribution, however, can often be marked by sharper, more unpredictable swings. Choppier action as that balance shifts between buyers and sellers.
That's an incredibly helpful comparison. Downtrend versus uptrend before, price bias, volume patterns, emotion, institutional role, chart patterns, volatility. Lots to look for. So let's get practical for our listeners. If someone's looking at a chart right now, what are some concrete techniques to spot potential accumulation?
Okay, practical tips. First, consider using weekly charts, not just daily ones.
Why weekly?
They filter out a lot of the short-term noise, so you can give you a much clearer picture of longer-term price stabilization and whether a solid support level, a base, is truly forming after that decline.
Good point. See the forest, not just the trees. What else?
Pay very close attention to volume trends within the potential accumulation range. Look for volume drying up on sell-offs or pullbacks.
So less selling pressure on the dips.
Exactly. And conversely, look for volume maybe increasing a bit on the minor rallies or pushes towards the top of the range. That pattern, low volume down, higher volume up, subtly hints sellers are disappearing and buyers are emerging.
Okay, watching that interplay between price and volume, any specific volume events to watch for?
Yes. Keep an eye out for unusual spikes in volume, or maybe large block trades, big transactions happening. These can sometimes be footprints of institutional activity, that's smart money stepping in.
Signs of the big players making moves.
Could be. Also, watch how well support holds. If a price level is tested repeatedly, maybe with those spring attempts below it, but the price keeps bouncing back, that suggests strong underlying buying interest is there, absorbing the selling.
So resilience at a key level.
Right. And finally, while it's more subjective, consider the overall sentiment. If you see extreme pessimism everywhere, forums, news, social media, about a stock or the market, sometimes that negativity peaks just as an accumulation phase might be finishing up.
Yeah.
There are fewer sellers left.
Interesting. When everyone hates it, maybe it's time to look closer.
It can be a contrary indicator sometimes, yes.
These are really valuable practical points. Now, you hinted earlier about a more modern, maybe beta-driven way to look at this, beyond just traditional charts and sentiment.
Yes. While traditional methods are valuable, they definitely have limitations. Chart patterns can be subjective, right? Two people might see different things.
Sure.
And sentiment can change quickly, maybe based on news, leading to false signals.
Yeah.
This is where a more quantitative, algorithmic approach comes in. It focuses on objective, real-time data.
Trying to get a more precise signal earlier, perhaps?
That's the goal, using sophisticated algorithms to identify accumulation with potentially greater precision and maybe earlier than traditional methods allow.
And this leads us towards the methodology behind AccumulationPro. Can you walk us through the core ideas there? What makes this quantitative approach different? Let's focus on the what and why.
Certainly. The core idea of our approach, the one powering AccumulationPro, is really digging into the actual flow of money using real-time market data. We're looking for the footprints of institutional buying.
So less focus on just price patterns, more on the capital movement itself.
Exactly. We move beyond relying solely on lagging price indicators or subjective chart interpretations. One key aspect is analyzing the net buying versus selling balance.
How do you do that?
We use advanced analysis on granular price and volume data to quantitatively figure out if, overall, more money is consistently flowing into an asset than out of it over a period.
Okay.
This lets us detect potentially the very early stages of accumulation, often before it's obvious on a standard chart. Getting that early insight is crucial.
That makes a lot of sense, tracking the actual flow. What other components are key to this quantitative method?
Another critical piece is evaluating comparative strength. We don't just see accumulation, we assess how robust it is.
How do you measure robustness?
We compare the current accumulation patterns quantitatively against a huge historical database of similar events. Is this aggressive, sustained buying? Or is it more tentative?
So you get a sense of the buyer's conviction.
Precisely. It helps gauge the potential strength behind any move that might follow. Then there's something we call money flow momentum.
Momentum of the money flow.
Yes. It goes beyond just the net amount flowing in. It analyzes the velocity, the speed, and acceleration at which capital is entering the asset.
Why is the speed important?
Strong, increasing money flow momentum can be a powerful sign of significant underlying demand. It suggests the accumulation is building steam and could lead to a more substantial, perhaps faster, price increase later.
So not just if money is coming in, but how strongly it's coming in. That sounds much more dynamic.
It is. And we also use sophisticated divergence filters.
Divergence filters, what do they do?
They're designed to spot subtle discrepancies between different data points like price momentum, volume, liquidity. Sometimes these divergences can reveal hidden buying interest that you wouldn't see just looking at the price chart.
Finding clues that are sort of hiding in the data.
Exactly. It increases the probability of identifying true accumulation and helps filter out noise or false signals. We also focus heavily on net liquidity.
Net liquidity. How's that different from just volume?
Traditional volume just tells you how many shares traded. Net liquidity analysis looks at the actual buy and sell orders being placed at different price levels. It gives a much clearer picture of the true supply and demand balance, the real market interest.
A deeper look than just total shares traded.
A much deeper look. And finally, and this is vital for managing risk, our system uses price action confirmation.
Meaning
it doesn't just jump on an algorithmic signal, it waits for a specific, predefined price movement to validate the accumulation signals the algorithms have detected.
So the price itself has to confirm what the underlying data is suggesting.
Correct. This confirmation step is crucial. It helps reduce the chance of getting in too early or acting on a false signal. It leads to more informed entry points with hopefully less risk.
It sounds incredibly thorough. A multi-layered, data-driven approach trying to see what the big players are doing, but with confirmation checks built in. So, bringing this all together for our listeners, why is understanding this accumulation phase and maybe having tools to help identify it so significant for them in the market?
Well, understanding accumulation, and especially being able to identify it early, offers a really significant potential advantage. It's an opportunity to position yourself before the broader market catches on that a trend might be shifting.
Getting in ahead of the crowd, essentially.
Potentially, yes.
Yeah.
By learning to recognize these signs, maybe through traditional methods or aided by more advanced quantitative approaches, you can align your decisions with what the sophisticated informed investors appear to be doing.
And even though the phase itself looks quiet.
Exactly. Even though it looks uneventful, accumulation can offer very favorable risk-reward scenarios. You might establish positions at better prices before a significant upward move potentially happens. It's about being prepared, being positioned for that next phase.
It really enhances your potential returns while also thinking about managing the risk.
That's the aim, strategic preparation.
This has been a genuinely illuminating deep dive into the accumulation phase. It's often overlooked, like you said, but clearly so critical. Recognizing these subtle signs, whether through chart analysis or more advanced data, seems like a powerful tool for anyone wanting a more strategic market approach.
Absolutely.
It really drives home that idea that the market's biggest moves often start quietly in these periods of preparation.
That's right. Understanding what's happening beneath the surface during accumulation really equips you with valuable insight into potential future direction. It's about looking past the noise, focusing on those underlying supply-demand forces and the actions of key players.
Well said. And for everyone listening, if you want to delve even deeper into these advanced methodologies we've discussed today and discover how cutting-edge algorithms, like the ones we've touched upon, are specifically designed to track those sophisticated money movements, while really prioritizing risk management for sustained long-term success, that we absolutely encourage you to visit AccumulationPro.com. There you can explore the advanced tools and resources designed to provide that quantitative edge in identifying these critical market phases. AccumulationPro.com.